Welcome to the Deep Dive. We're here to cut through the noise and give you the real insights from the latest earnings calls. Today we're diving into Jewett Cameron Trading Company, ticker JCTC. You probably know them for things like their lifetime steel posts. They just reported their third quarter for fiscal 25. And, well, it was a challenging one. A really significant external headwind made some serious waves.
Oh, it certainly did. Looking at the results for the period ending May 31st, 2025. Well, revenues took a big hit. It fell 21% compared to last year, landing at $12.6 million.
Oof. And I imagine the bottom line felt that too.
Absolutely. Diluted earnings per share swung to a loss. It was about $0.18 per share. That's quite a turnaround from the profit they posted the year before.
Yeah, quite a swing. What about margins?
Also under pressure, gross margin compressed 360 basis points.
3.6 percentage points.
Right, down to just 15%.
Wow. So, I mean, these numbers are clearly weaker than last year. Seems like a miss compared to hopes for stabilization, maybe? Investors probably weren't thrilled.
No, definitely weaker trends. And yeah, the market reaction suggested some real disappointment there and missed expectations.
Okay, so let's get into the why behind these numbers. What was the main challenge management highlighted on the call, the elephant in the room?
Tariffs, plain and simple. But it wasn't just the tariffs themselves. It was the chaos around them, the uncertainty, the constant, rapid, unpredictable changes, which rates, which products, which countries. It was all over the place.
So the unpredictability was the real killer.
Exactly. Management directly linked the $650,000 loss to that. It caused retailers and consumers to just stop. They deferred purchases. And of course, you had the direct cost impact to higher tariffs, stressed logistics, pushing up transportation costs, hitting those margins we just talked about.
Right. And it wasn't just one hike, was it? It felt like wave after wave. You had the original China tariffs, then more China-specific ones piled on early this year, Feb, March, April, then more increases in May, and then boom, global steel and aluminum tariffs doubled to 50% in early June.
That's right, June 4th. And crucially, with almost no warning. No time for importers like JCTC to really react or adjust pricing smoothly.
Man, trying to manage a supply chain in that environment, almost impossible.
It really highlights the vulnerability, doesn't it? How fast can companies really pivot when policy shifts that dramatically overnight? It's a huge question.
Okay, so despite that storm, were there any bright spots? Did anything perform well?
Yeah, actually, there were a few pockets of strength if you dig into the segments. Lifetime steel post sales, for instance, they jumped 85% year over year.
85%. Wow, that's huge.
It really is. And it helped cushion the blow elsewhere. The overall metal fence business was actually only down 4% compared to last year.
So strong underlying demand there, despite everything.
Exactly. It suggests the product itself is still very much in demand, even with the tariff noise.
And they were expanding placements too, right? Something about Home Depot displayers.
Yeah, good pickup. Over 422 of those lifetime steel post displayers installed at Home Depot. That's up 88% just since November 2024.
Yeah. Impressive growth. But I thought I saw they paused adding new ones. What's that about?
Right. They did tap the brakes there temporarily. It wasn't lack of demand, though. It was more about managing resources. They needed to prioritize getting inventory to the existing displays, especially with the production and logistics constraints from bringing these new non-China factories online.
Gotcha. Sensible move. Any other bright spots?
Yeah, the My EcoWorld segment, that's their compostable products line. Sales for the first 9 months of this fiscal year are up 265% year over year.
Whoa, 265%.
Big growth, driven by branding efforts beyond just pet products and also strong demand internationally, like in Mexico, where, U.S. tariffs aren't a factor.
Okay, interesting. So where did things look weaker then? What were the main areas of weakness?
Well, the pet business took a significant hit, down 44% year over year. Seems like it's still dealing with the aftermath of that post-pandemic supply chain buildup.
Still unwinding, huh?
Seems like it. And then the wood fence and lumber side had some issues too. They had an interruption fulfilling cedar fence orders right before the spring season kicked off.
Not ideal timing.
Definitely not. But they have apparently expanded their supplier base since then and expect to catch up on demand from July onwards. So, potential for recovery there.
Okay. And what about Greenwood, the bus industry segment?
Greenwood sales were down too, decreased 24% to about $0.7 million. Management said that was due to a supply issue, but not one related to Greenwood itself slowing down production for their customers. They still see growth potential there, but flagged another potential tariff issue, this time on Canadian wood products, which could hike their raw material costs down the line.
Man, it's coming from all angles, isn't it?
It really illustrates how complex this environment is. It's not just China tariffs, it's broader supply chain issues, potential future trade shifts, a real web.
So, faced with all this,
Yeah.
this turbulence, what's management actually doing about it? They can't just be sitting there.
No, definitely not sitting still. They highlighted several proactive steps. First big one, supply chain diversification. And what's really notable here is they started this way back in early 2023.
Oh, wow. So well before these latest huge spikes.
Exactly. 2 years ahead, moving production away from China, multi-sourcing. They now have suppliers in Vietnam, Malaysia, Bangladesh, offering competitive pricing and, crucially, lessening that direct tariff impact. That foresight looks pretty smart right now.
Yeah, that's genuinely impressive foresight. What else? Prices, costs.
Yep, implementing price increases across the board to try and align better with the higher costs. They also mentioned enhancing their pricing process itself to be quicker, more responsive.
Makes sense. Need to be nimble.
And on the cost side, big moves. Operational efficiency reviews, process improvements, tech adoption, and a significant organizational change. They reduced personnel by about 20% back in April.
20% headcount reduction. That's major. That should definitely help the cost structure going forward.
It should provide a structural tailwind to margins, once things stabilize a bit. And one more thing, asset monetization. They're actively trying to sell or lease a non-core property. It's an 11.6-acre site in Oregon, a former seed cleaning facility. Book value is only around $550,000.
Okay.
So for a company this size, any sale significantly above that book value could bring in some welcome cash and, boost shareholder value.
Right. That could actually be quite meaningful for a microcap like JCTC. Okay, so diversification, price hikes, cost cuts, potential asset sale.
Yeah.
Quite a few levers being pulled. But despite all that, the outlook for Q4 is still kind of cautious.
Yeah, that's the message. Management basically said, expect the Q3 challenges, the uncertainty, the hesitation from retailers and consumers. Expect that to bleed into Q4, at least until there's more clarity and finality on these tariff rates.
But any signs of life? Any green shoots?
They did note that demand for their metal goods picked up a bit in June. Seems customers were running low on inventory and maybe starting to accept the new higher prices driven by tariffs.
Ah, okay. So maybe starting to adjust to the new reality.
Perhaps. But they were quick to say it's not back to normalized levels yet.
Got it. So the long-term view for management is basically wait for the tariff dust to settle.
Pretty much. They believe a resolution to the negotiations will eventually lead back to more normal purchasing patterns. In the meantime, they're focused on those internal levers. Growth drivers, innovation, efficiencies, the asset sale, trying to navigate through it.
And the balance sheet, how's that looking amidst all this?
Inventory ticked up slightly to $15.3 million, partly due to slower customer buying, partly because they were securing that cedar lumber supply. Cash was $1.2 million at the end of May, stockholders' equity at $23.1 million. They did draw down $2.4 million on their line of credit, which they noted is pretty typical for their seasonal working capital needs, and that line's been extended through June 2026.
Okay, thanks. So let's talk investor context. How did the market actually react to the call?
Well, the stock closed around $3.79 the day before the call, July 14th. And the next day it finished around $3.68. So a downtick, about 2.9%, but on pretty heavy volume, like 5 times the average.
Okay, so a noticeable reaction, but it wasn't like the stock was flying high before this, right?
Not at all. This continued an existing trend. The shares were already down 16% year to date before the call. They even hit a 52-week low back in April, around $3.26, right when those steel tariffs doubled initially.
Ah, right.
There was a brief rally attempt in June, maybe on hopes of tariff relief, but that fizzled out when more hikes were announced at the end of May.
So the market was already pricing in some pain.
Yeah, and this earnings report basically confirmed those fears. Investors were clearly hoping the strength in things like lifetime steel posts could offset the tariff pressure, but it didn't. The muted outlook just reinforced worries about a longer downturn, and you likely saw some small cap funds trimming their positions.
Does this impact other companies in the same space? Or is JCTC kind of uniquely exposed here?
It's definitely having broader ripples, but JCTC's situation does seem particularly acute. Other building products companies with China exposure, names like UFPI or TBLD, they also traded down after JCTC's report, but maybe only by 1 or 2%. Milder reactions.
Okay.
So it really underscores JCTC's specific leverage to metal imports. It gives you a really clear window into how heavily these trade policies can impact certain business models. really drives home the importance for investors of looking hard at supply chain resilience and, geographic exposure in this kind of volatile environment.
Absolutely. Okay, let's shift gears now to our not financial advice segment. Just a reminder, this is purely for discussion, speculation, educational purposes. We're not recommending trades, and all investments carry risk. Always do your own research.
Right. So with that disclaimer, here's an idea, maybe a bit outrageous, but potentially plausible.
Yeah.
Consider a contrarian long position in JCTC.
Ooh, contrarian. So betting against the current negativity.
Exactly. The idea is that the market might be so focused on the tariff headwinds, which are very real, don't get me wrong, that it's overlooking the proactive steps the company's taking internally, betting that we're at near peak negativity.
Okay, unpack that thesis. Why might the market be overlooking things?
Well, first, the stock's already taken a beating, right? Down 16% YTD, hit those 52-week lows. A lot of bad news might already be priced in. Second, the market fixates on the known problem tariffs, but might be underweighting these internal catalysts JCTC is pushing.
Like the supply chain diversification.
Precisely. They started that back in early 2023, 2 full years before the latest tariff storm really hit hard. Moving to Vietnam, Malaysia, Bangladesh, that foresight puts them potentially ahead of peers who are only scrambling now.
Okay, that's a fair point. What else?
The cost cutting. That 20% personnel reduction is significant, plus ongoing efficiency drives. Those create structural tailwinds for margins once revenue finds its footing again. That's real, tangible improvement.
And the product strength.
Yeah. Don't forget that 85% growth in lifetime steel posts or the 265% jump in My EcoWorld. It shows there's underlying demand and innovation happening. That could really rebound when the macro picture clears up even slightly.
And the property sale potential?
Right. That Oregon property, book value, just $550. For a company that just posted a $650 quarterly loss, selling that land for, say, even a modest profit over book could provide a really meaningful cash infusion, could boost equity, maybe even trigger a re-rating of the stock by the market.
So the bet isn't that tariffs magically disappear tomorrow.
No, not at all. It's a bet that the market has overcorrected on the downside, that it's underestimating JCTC's resilience, the impact of their strategic moves, the diversification, the cost cuts, the potential asset sale. It's basically betting that these internal operational improvements can eventually override the external tariff noise that everyone's currently focused on.
Interesting angle. A bet on operational execution in the face of macro headwinds. Okay, so let's try to wrap up this deep dive on Jewett Cameron Trading Company.
Right.
What's the key takeaway here? It seems like they're in a really tough spot with tariffs, but they are actively fighting back.
That sums it up well. They're navigating a really challenging tariff storm, no doubt about it. But they're not passive victims. They're making decisive moves, diversifying the supply chain early, adjusting prices, significantly cutting costs, near-term outlook. Still muted, still uncertain. But you see these pockets of strong growth, like in steel posts and eco products, and clear operational efforts underway.
So maybe a final thought for you, our listeners, to chew on. In today's world, with seemingly ever-increasing geopolitical friction and trade volatility, what does JCTC's experience really tell us?
Yeah, what does it say about building genuinely resilient businesses? And maybe more importantly for investors, how do you spot the companies that aren't just reacting to crises, but are proactively building, future-proof supply chains, future-proof operations? Something to think about.
Indeed. Lots to consider there. Thank you for joining us on the Deep Dive.